Hello everyone, welcome back to another video. So today we're going to be talking about the difference between credit unions and banks and really comparing from a commercial banking career perspective, what are the pros and cons of working in each type of environment. So let's jump into it. So the commercial banking landscape is broad, and when you're choosing what kind of jobs to apply for, it's an important question to ask. What type of bank are you going to be working for? Are you going to be working for a large bank, a specialized private lender, an equipment financing company, or a credit union? And so oftentimes a lot of the jobs that are available for entry-level students coming out of university or colleges are going to be with the big banks and or, your local credit union. And so when you're comparing the two paths, there are key differences, and it's really important to understand how the origin of these organizations actually influences the culture and the attitude of those companies and how that will influence your day-to-day career within those organizations. So at a very high level, just to give you some background, the credit unions are actually member-owned organizations that are specifically created to serve a target mandate. And that mandate could be a specific regional market, like a geography, a state, a region, a city, or an industry. Medical professionals, agricultural, farms. So there are different farming organizations or medical professional credit unions that are targeting a geography. And so, really, the whole point is that you want to pool funds together for these organizations to deliver a more cost-competitive product to that target marketplace that you may not get from the larger wholesale banks that are trying to cover the entire vastness of the US or Canada and may overlook certain demographics or target markets. But the thing is that credit unions are actually nonprofit organizations. So the mandate for a credit union is to deliver those products at a cost competitive level because it can use those profits to reinvest into the business to lower their pricing so that they're not really price gouging or looking to raise their pricing to raise profit levels, but rather just maintain and cover their costs. And so that's why credit unions still exist to this day and serve an important function. They are a cost competitive product segment for certain demographics or industries that may be overlooked by the larger banks. But the problem with this, or not the problem, but really the challenge with credit unions is that the culture of that company is very different compared to a bank because a big bank is owned by publicly traded, public shareholders. It's publicly traded. It has to deliver on quarterly growth targets. It has a long-term vision to double the business or to grow its profit base and its asset base. So it's very growth-minded, whereas credit unions, comparatively, they're not focused on growing profit. They're really focused on delivering the service and being stewards of the existing bank's capital. So taking a more conservative approach. And that really extends into how it will influence your day-to-day job if you were to get hired by one of those commercial banks. And so just as a quick background, let's look at some examples of credit unions to give you a sense of, the different types that exist out there. So I think in Ontario, there's probably about 61, but, really I picked a few kind of specific ones. So the first one is the Healthcare and Municipal Employees Credit Union. I think there's like 3 or 4 branches. It's very, very small, but the whole point of this organization is to provide community banking solutions. So ATMs, retail solutions, a little bit of commercial lending, mortgages and all that to employees and families of healthcare related workers or government or people that hold government jobs. So that I would say is more of an industry focused credit union. Now there can be even a nationality or different types of identity credit unions where it could be Islamic or it's a certain nationality. So another example is the Ukrainian credit union, where here their focus is really on supporting cultural, educational, religious, charitable, and any other types of recreational activities related to the Ukrainian community. So either you are Ukrainian or you have some sort of relation to the religion of that, Ukrainian community, that's really their target marketplace. So if you are someone that's outside of that target marketplace, either you typically are not served or you're not really going to get the same competitive products. It's probably just better for you to go to the bigger banks. And then the last one is more of a regional, geographic focused credit union. So I picked out, for example, the Sudbury Credit Union. Sudbury is a city in northern Ontario. And so, for them, they serve 15,000 Sudburyans and really their day-to-day retail and business banking needs. So again, for banks that maybe don't want to go all the way out into rural parts of the country, a local credit union can be that dedicated community-focused bank solution for those people. So it is an important function within the banking landscape. But again, These are all nonprofit organizations. Now, on the other side, the chartered banks, they're federally regulated for-profit companies, and they're oftentimes publicly traded on the stock exchange. So, as I mentioned before, their focus is growth and driving profit and really growing the asset base and winning market share so that, the managers that are managing these banks get bigger bonuses and obviously are able to maintain their positions at a high level. So the mentality of the banks is significantly different compared to the credit unions. And that naturally extends into the competitive landscape that exists today in Canada. So, just looking at 2021 stats, about 3.7% of the mortgage business in Canada is with the credit unions. The other 96+% is with chartered banks. And so that goes to show you that even though credit unions exist, they're still a very small part of the industry, and they have no real interest in trying to win more market share away from the banks. Their focus is more on being stewards of their capital, growing at a very steady organic rate, not taking big risks and big swings compared to maybe the banks, which are a little bit more aggressive on the risk side. So this for-profit, non-profit culture and influence between credit unions and banks is what influences your commercial banking career decision as well, because it's very important to decide what works best for you. So let's jump into some of the positives of working for the banks first. We'll go into the cons, then we'll compare the pros and cons of the credit unions, and then really summarize all of that. So on the positive side, when you're working for the banks, again, their focus is on growth. And so to grow, you need top talent, you need to pay that talent, and you need to train your talent. So what you're going to see is that the resources available to you as a new employee or someone that's wanting to learn are much more abundant and available at the banks compared to the credit unions. So, for example, the training for new hires, the vast number of people that they're hiring to support these 50,000 employee organizations, they have rotational programs, they have dedicated mentorship programs, workshops on an ongoing basis. So the training resources and the infrastructure is very, very strong. So if you're looking for a good rounded training experience, the banks are probably going to provide a better experience for you. As well, just simply due to the size, when you come into a commercial banking team, the number of deals that you're working on, the number of clients that the team is working with is usually larger. Community-focused credit unions, they have smaller books because they're regional in focus. But, I remember working for a big Canadian bank, and even though we covered a region, we could go outside of that region and win other business if it landed on our desk. And so we had a very, very big book. I would say, for an average relationship manager, you may be managing 100 to 150 connections or client relationships at the big banks, and that could be half of that at a credit union. So when it comes to wanting to get deal experience, exposed to different transactions, the size of your book and the deal volume is important to you because you want to get trained more quickly, to experience commercial banking more quickly. And so that speed and that the broad range of deal flow is usually better at the banks. And then lastly, again, because the banks are trying to attract the best talent, they also usually offer the better compensation packages and bonus programs. And so I kind of pulled up, this is 2022 numbers, but on Glassdoor online, kind of the three major credit unions within the Ontario marketplace and the Canadian marketplace, which are Meridian, Libro, and First Ontario Credit Union. So these are the three kind of major ones. They have about 29 billion in assets, 6 billion in assets, 5 billion in assets, and I would say I think it was like 30 or 40% of the marketplace is held by them. And you can see the number of employees is 2,400 and 700. So relatively medium-sized banking institutions. But then you take, for example, one of the big Canadian banks, an RBC. They have 1 trillion assets under management, and they have 85,000 employees. So comparatively, they're a much bigger machine, and the HR department and really replacing that talent, you need to pay for that talent. And so that really reflects in the average salaries on Glassdoor. So for an account manager, more of an entry-level junior position, at a credit union, 89,000 average, 96 or 90,000. Comparatively, at a big bank, it's 111,000. And then as you climb in seniority, a senior relationship manager or commercial banking director, Meridian had some information, 128,000, 148,000 compared to 197, 198 plus bonus programs on top of that, which they typically don't disclose on Glassdoor. So you can probably see there's going to be a big jump in salary performance between the banks and the credit unions. Now, some other benefits are because the banks are growth focused, their attitude towards the marketplace and wanting to offer more competitive, aggressive products also is a key benefit to consider because really for them they're trying to win business and win market share. So offering the most competitive interest rates, the longer amortization periods, more flexible or sexy solutions in terms of how to structure a deal, finance that property or finance that M&A deal, that attitude and the risk management approach towards that is a lot more aggressive than a credit union. So really overall, when you're trying to determine what type of product am I selling and where am I going to be more competitive, working for a bank and pitching their product is usually going to be more competitive than pitching a credit union's product in a general deal sense, because you can more broadly pitch a broad range of commercial properties, M&A loans, equipment loans, whatever the case is, because the bank offers such a broad range of solutions available to you. Whereas a credit union may be really good in one area and offer one specific product, but they don't have that repertoire of multiple products that they can offer compared to the banks. So being competitive and selling a competitive product in a sales role is critical when you're thinking about where should I start my career, because here you're selling a more competitive product, so hopefully you're going to get more deals done, and which will help you get paid as well. And then the last one is career mobility. So because these banks are so big, because they have all these different divisions, moving from commercial banking sales to risk management, or moving out of commercial banking entirely into wealth management, to personal banking, retail banking, investment banking, capital markets, trading, whatever the case is, because there's such a big financial supermarket, you have the mobility and ability to move within the bank if you wanted to laterally and get exposed to other commercial financing related type divisions, versus with the credit unions, they're significantly smaller, and really the business financing aspect of a credit union is very small relative to the retail banking side, which is more the focus for a lot of these community banks. And so the ability to get exposed to different opportunities, have a very rounded management experience or entry level experience through rotational programs, that comes from working for a big bank versus working for a very small community credit union. Now, the challenges with the banks, I would say, are that because they are bigger institutions, that whole big company mentality, naturally there are some downsides to working for a big organization. The first is because they're offering the best salaries, typically they're also the most competitive to break into. So if you're someone that maybe is not coming from the best school or doesn't have the best grades or the most relevant summer work experience to really help you break into those rotational programs and get those interviews and meet with those recruiters, then it's going to be a much harder hill to climb because it is competitive. There are a lot of people applying for these jobs. And so to stand out, it's going to be harder to do that if you come from maybe more of a disadvantaged learning or international background, especially for international students. They're just unfortunately at a disadvantage when they're applying for these local domestic jobs when they're competing against domestic students. Now, the other downside to working for the banks, and I remember feeling this myself when I was in the commercial banking world, is that because there's that insistence to grow and achieve growth, the sales pressure and the sales environment of pushing for more and more and more deals, increasing your sales budget on an annual basis. And that sales budget means the amount of deals and the amount of loans that you have to fund on an annual basis. It every single year grows in size because naturally as a bank grows, they want to continue to increase their targets for further and further growth. So I call it the sales treadmill, running on that sales treadmill and trying to meet the expectations of larger and larger bonus targets is a little bit tiring when you do it for 5, 10, 15 years. And so, I used to see this from with my senior managers or people that exited the groups. The primary reason they would leave is the fatigue that came with at the start of every fiscal year, the next fiscal year, their budget goes back down to zero, and they have to start, filling that meter, trying to get to the target again. And so it can get a little repetitive to try to source further and further business. And so that attitude towards sales pressure is a constant cultural thing that's going to influence, just your day-to-day thinking. And for some people who maybe are not as strong in sales, who may not like that constant pressure of thinking that, oh man, I always got to be looking for deal flow. Well, if you wanted to take it at a more lax or slower pace, that environment is going to be a little bit challenging for you. And then the last thing is just because it's a big company, I call it the company culture syndrome, which is, you're a big cog, you're a small little tiny number in a big machine, and you sometimes feel that, you can't, skirt, change your approach to the market. It's very cookie cutter. It's very, here's our lending parameters. This is what we're looking for you to do. Find these real estate loans or find these equipment loans within this band, and that's it. And so if you wanted to be a little bit more creative or go after a more unique deal, the banks are not going to be placed to do that. Usually that comes when you work for smaller, more nimble lenders that have the flexibility to fill those gaps. The banks are not there to fill the gaps. The banks are not there to be the creative lenders. They're the wholesale solution for the broad general marketplace. The more niche solutions come from when you're working with smaller organizations. So the banks are always going to have a disadvantage. And if you're the type of personality that wants to work on those more unique deals, that may be a little bit of a challenge that you need to get used to. Okay. Now, on the flip side, what are some of the positives? So we talked about the strengths of the banks, but there are some strengths when it comes to working for credit unions. It's really about what your career mentality is. And I would say the first and the big one of the most common things that I always hear, because I had a few buddies that worked in the credit union space, is that these organizations are a lot smaller and therefore flatter. So what that means is that, the level of middle management between you and senior management or you and the CEO is very, very thin. So you may have a few junior relationship managers, a senior director, and then literally the VP of commercial banking, the person that all decisions flow up to. So your exposure to upper management and your ability to gain more responsibility, if you're good enough, can actually come more quickly if you're in that credit union environment, because you're able to really have direct contact with management. And if they really, really like you, they can start grooming you, and you can more quickly get brought into that upper management room, which is something really exciting and interesting if you're early on in your career. Now, the second advantage is because, comparatively, they may not offer the best salaries compared to the larger banks and are maybe lesser known and don't have the same brand reputation and visibility as the big banks. Some credit unions, you'll see that the hiring competition and the ability to break in is actually a lot easier. So the competition for those jobs is lower. Yeah, there may be not as many jobs available because they're not hiring as much, but at the same time, the number of people applying is much less. So if you find that you're not really breaking into the banking sector as much, then maybe try applying for the credit unions, because you probably are going to have a higher likelihood of breaking into those types of employment opportunities. Now, the third benefit is the growth expectations. And I would say this is a good and a bad thing. Credit unions, are not growth minded in their business and P&L sense, because again, they're not publicly traded and owned by shareholders that demand profits. But at the same time, it allows you to really approach initiatives in a much slower way and reduce the pressures on employees. So we talked about that sales culture being a negative for the big banks. Well, here there isn't that pressure of constantly growing the budget, exceeding targets and all that. It's a much more cushier job. And so if you're someone that really wants to work very hard as a workaholic, wants to put in those 60, 70 hours early on in your career, it's probably not the best place to start in the credit union environment. But if you're someone that's looking for that work-life balance and you want to just slowly kind of continue to grow your career over time, but not invest heavy hours into your work, this would be a better environment for you because of that cushier, more stable environment where, again, the growth expectations, I would say, are a little bit lower and they're not as aggressive as the big banks. And then the last benefit is, I mentioned that, most of the big banks are competitive with a lot of their products, but the interesting part is that the big banks can't be competitive in all segments. And so ultimately, a lot of credit unions are really, really good in their niches. So if they're focused on, say, for example, commercial real estate, so, certain credit unions in Canada like Meridian or Laurentian Bank, or even Libro or those kind of organizations, they're focused on actually financing real estate development projects. And so any mid-tier real estate development project, you may run up against a lot of the big banks and actually beat them, because that is your market focus. So whenever you're applying for a credit union, it's really important to understand what is their niche, what is their really strong product segment in the commercial lending space, and then really compare that to whether you want to get exposed to that or not, because that's probably where you're going to spend a lot of your time in. That's where you're going to win a lot of your deals in. Trying to go beyond that niche, as I mentioned before, is a downside with the credit unions, because trying to do commercial, cash flow loans or management buyout loans, those are a little too aggressive for the credit unions. But if a credit union is highly focused on commercial financing of real estate properties and commercial real estate, like a Meridian, and you wanted to get exposed to real estate financing, Meridian is a perfectly good place to be, because they have a good competitive product segment and they win mandates away from the banks. So that would be a good opportunity for, even for you at a credit union where it's easier to break in, to get the same level of deal flow experience as the banks in their niches. Now, the cons alternatively are some of the benefits of the big banks. So probably this is a little bit repetitive, but just to clarify, the cons are, the lower ceiling when it comes to career progression. So with the big banks, you have all these different divisions that you can move laterally in, get exposed to different opportunities. The thing with the credit unions is, because they're so small, your ability to progress upwards, there's not a lot of middle management roles, because again, it may be the relationship managers, a middle manager, and then the VP of commercial banking. And so if your middle manager and your VP have been in that role for 10 years and they're 45 and they have no intention of leaving or retiring, well, then you're kind of sitting around waiting for many, many years to get promoted to the next level. So the ability to progress forward is much slower. And really, from a mentality perspective, a lot of the management team, and this comes from some of my buddies that worked at the credit unions, a lot of the management team are not really focused on developing their talent to kind of give them exposure to more senior management roles. Again, there's just not enough. There's just not enough work to go around to warrant that development of further exposure to management. Ultimately, a lot of these, relationship managers, they're just processing the deals, originating the deals, kind of steady Eddie, doing the same thing year over year. And that's nice for some people. But if you wanted exposure to more interesting opportunities on an ongoing basis to progress your career, that attitude of development is not really present in a lot of credit unions, because again, that's not their mandate with their talent. Their talent is really focused on just processing their existing product segment. Now, as well, as I mentioned, while the credit unions are good in their niches and what they're really focused on, outside of that, if you wanted to kind of be a little bit more creative and more aggressive to gather and originate opportunities in equipment financing, or commercial, or M&A financing, ultimately the risk department for a lot of these credit unions is a lot more conservative, and so their overall product competitiveness in the broad general landscape is a lot lower. And so you're at a disadvantage if you're going up against the big banks on just a general financing opportunity, an operating line, for example. Really, the focus of the credit unions is filling those niches and filling those gaps. So for someone that is seeing a lot of opportunities, that wants to see a lot of opportunities, may get a little frustrating, and you may feel like your hands are tied because you can only finance and play in certain buckets, and other buckets you're going to get blown away by the bigger banks that are just much more competitive. And I would say this is especially true in the Canadian marketplace, where you can even tell, like, if a deal is going to be a credit union deal or a big bank deal, just based on the owner's expectations, the type of business, and really what they're looking for. If it's something creative, it's something a little bit more aggressive on the cash flow financing side, most of the credit unions are just not even going to be at the table. They don't even pitch those products because they know they won't be able to compete with the big banks. And then the last one, again, is there's the lower compensation levels and the salary growth. So the thing with the career progression is, at least with the big banks, maybe you're not going to progress within your division, but you can move laterally and then get promoted to the next manager level and increase your salary band on an annual basis, which allows you to see that salary growth year over year or over the next 5 years. But again, the challenge with being in the credit union is, yeah, you may be hitting it out of the park and maxing out your bonus program, but you're still within a certain salary band at that level. And until you get promoted to the next level, you may be able to deliver fantastic growth or fantastic sales, but you're not really going to get full value for that from a compensation perspective. And you're not going to see that growth quick enough. relative to if you were with the banks. So again, if your focus is more on just work-life balance, just a nice steady salary with, just kind of performing your duties, this is a good opportunity. But if you're very aggressive, you want to max out your salary and hit it out of the park year over year, you may start to feel underappreciated over time because you're not really getting paid market rate for what you're bringing to the banks to the table, right? So overall, these are the pros and cons of working for the chartered banks versus the credit unions. Each employer offers different opportunities, and I wouldn't say that credit unions are a bad place to work. But for someone like myself, with my personality, where I want to sell, I'm very aggressive. I'm a bit of a workaholic. I just want to kind of make money early on in my career to really allow myself to maybe relax a little bit later on. For someone a little bit younger like that, the credit union environment, I would warn you about, because it's not as good as the bank environment in terms of allowing you to be aggressive. But say, for example, you're in the middle of your career, you're more focused on starting a family, having that flexibility to pick up your kids or drop them off at school, and the sales pressure is not as high. That can also be a pretty positive environment to be in if you're maybe more at the middle stages of your career. So it all depends on your objectives. And so overall, just to give you a quick summary, the banks, much more competitive products, better employee training and infrastructure, more career mobility to get exposed to different divisions, a better salary and bonus structure, and also just they're able to focus on a broader marketplace and offer different commercial financing opportunities to a more diverse range of clients. So if you want to just get exposure to the most amount of deals, the banks are the place to be. Now, obviously, because the banks are on the bigger end, they're offering the better salaries, it's more competitive to break in from a job perspective. The sales pressure is something that I will tell you is real, and you will feel it over time. In the early years, you feel like you meet your budget, you kind of pat yourself on the back, you're really happy. But year over year, it just the counter resets back to zero, and you have to start it all over again every single year. And so that sales treadmill and that pressure is something that gets a little bit frustrating. And then as well, just being a big company, for me, I remember feeling this where there was no personality from senior management. They didn't really care about you. You're more just delivering on your objectives. And again, you were getting paid for it, but sometimes you also want to feel that it's more of a smaller company team feel. And sometimes with these big companies, that doesn't feel that way, and you're not going to get that exposure. Now, for the credit unions, they're much flatter organizations, so you have a lot more independence and contact with senior management. So if you're good, you're going to stand out a lot more quickly and maybe even get favored by management and groomed by management, exposed to different opportunities. They're able to be strong in certain target markets. So if Meridian is in the commercial real estate space, they're going to be very good. If credit union ABC is really good in financing medical businesses, then they're going to be very strong in medical opportunities. But financing an agricultural opportunity, if they're a medical credit union, just doesn't make sense. They probably won't even be competitive enough to be in the room. Now, as well, the competition to break into a credit union is a lot less from a job market perspective. The sales pressure, as I mentioned, is lower. And this whole community focus, because these banks are community focused, from a social giving perspective and the feeling of you adding value to local businesses and focusing on the smaller businesses rather than the big companies that the banks work with, if that is of importance to you, that is also a benefit that you need to consider. The cons, of course, are lower salaries, the overall product conservatism of their lending products. You're not going to be able to be as competitive in a lot of different segments. There's very limited opportunity for career growth or lateral mobility because they have much fewer divisions, and commercial financing within the credit unions is usually not the key business focus. And then lastly, the amount of deal volume and deal experience, especially early on in your career when it's important to get exposed to different deals, is much less compared to the banks where it's a lot more high volume and you're dealing with a lot more clients. So overall, there's advantages and disadvantages to both, but hopefully you did appreciate the video and you found it helpful. If you do have any questions, you can obviously comment below or reach out via LinkedIn or via email, and I can hopefully answer some questions and kind of talk you through your decision making. And if you found the video helpful, then please do like and subscribe to the channel for more of this type of content. And as well, please share it with anyone that you think it would help them as well. So thank you guys and have a wonderful day. Thank you.